Okay. Yeah. Thanks for Matt handling all the. Yeah, that's amazing. So I'll announce that. Yeah. Yeah, I see. Good job. Yeah. Yeah. Has it? Yeah. I didn't tell people to check in. The check-in, I think, is fine, right? Okay. Yeah, yeah. Okay. Yeah, they are. I see them. Yeah. Yeah, the files. Okay, perfect. Yeah, that's really good, actually. Okay. So, yeah. Yeah. Okay. Can we start? We'll start. And yes, yeah, 9:59. Okay, yeah. Start. Yeah. I love Lisa and my financial horizon color. Okay, I'm gonna start. Oh, thank you. Good question, by the way. Yeah. Hi. All important C code this year. Yeah. Hi, everyone. We're going to get started here. So if I can invite you to take a seat, that would be amazing. All right. So as you grab your coffee and refreshment and grab a seat, we'll get started here. Quick. Yay. Jos has fans here. I love that. I love the love. Yes, we love Jos. So again, couple of announcements before we get started. First of all, speaking about, we have a lost and found item already. Samuel Pasternak, you have a Visa debit card here. If you give me the private key to this, I'll give this back to you. We'll share. I can just tap it. Oh, it doesn't have a tap. Okay, thank you. Also, just to let you know that recognize that some of the slides, because we have one projector here, and so then the slides may be a bit hard to read. So what we've done now is that all the presentations for all the speakers have been uploaded into Feedloop. So if you click on the session and at the bottom of that screen, you'll see something that says file. All the presentations are there. The previous sessions, we're just uploading them. So it might just take a second to refresh. And that way you can follow along if you are not a front seater like I am. If you're at the back seater, you can still see all the slides okay. Okay, so without further ado, I am so excited for Jos to be here. And Jos and I have known each other for a number of years. She is an amazing speaker. She actually speaks accounting in English. Does that make sense? Like, actually, you can understand it. So Jos is going to be presenting on the Jos, the CPA speaks insurance. And so always a crowd favorite. So we're excited for her to be here. So I asked Yas about her favorite costume, and then she has a really great story. So her costume is a spider, not Spider-Man, but spider with legs and all that. So she can tell you a little bit more about it. But you know, she had three friends that dressed up as a spider, and they had all the outfits going. And that Halloween party was also the Halloween party where she met her husband, and they are still together today, 30 years later. So I feel like that we can give her a hand for that. Amazing job. so, so I had to Google, what does it mean when you dress up as a spider? So it says here that spiders maintain an outwardly calm demeanor that captivates others. I think that's true. They are hardworking and patient, take a creative approach to their work. Having cast their web, spiders can patiently wait for the desired outcome. Their intricate web astonish everyone with their creativity. Thus, their diligence can bear fruit in almost any area. They refuse to give up when facing difficulties. and having put in the effort, expect a suitable reward for their work.
Wow.
So with that, let's give Jos a big welcome. We'll take it from here.
Thank you. Holy, I thought she was just going to go into some dark world talking about spiders, but that was so positive. I loved it. Oh my goodness. So that is a true story. Me and my husband have been together for a number of years. People always ask, well, what did he dress up as? It was a ghost. Like he put a sheet on, he went to a fabric store, put some holes in, and there's my husband, right? So that's the story and why I love Halloween. Today, not Halloween, but tax. Just as scary? Maybe. When I think about my topic today of estate freezes and more, this could be a whole afternoon session, etc. I wanted to just kind of give you two major kind of case studies that sort of illustrate where the world of estate planning comes in, where tax layers in, and of course, insurance. So I think that's a good combo. How I'm going to start, I've got, of course, important considerations, etc. But here's where my kind of world and thought is. We'll give the perspective how estate freezes are, the conversations that you may have with CPAs, where their mind is coming from, twisted as it may be, and then layer in how then things like wasting freezes and rollovers can kind of still lend itself to the insurance opportunity. So again, it is meant to be collaborative. Whenever when I sit there with a team of maybe there's myself, the accountant, the lawyer, etc. That's to say, what do you bring to the table? What do you bring to the table? What are the options, right? We need to explore that because we may not know them at the time in talking with the client, etc. So let's do this first. Here's John, typical taxpayer, typical parent. Why would he consider an estate freeze? Okay. Well, we bring out good language. We say, well, John, this is good succession planning. This will be good estate planning. You can bring your children into the fold. All this nice, positive language. And by the way, John, you probably could do this on a tax-free basis. And we can do this also on a deferral basis. Sounds good, right? Very positive language that we use with our client. Even accountants will use that language. Now, if we think about really from an accountant's perspective, and we say, well, an estate freeze really is transactional. That's all it is. An estate freeze is just reorganization. So what am I doing in simplified form? I then go, okay, if I'm going to freeze the value of John's shares, I'm then going to freeze the value at its fair market value at a given point in time. Okay, so that sounds good. So now that lends itself to any future growth, I'm going to pass that on to his heirs, his successors. So I basically frozen his value at that time. But the thing is, what most taxpayers don't, realize is that they're still holding now preferred shares, right? We've done an exchange. These common shares that he originally had, he's now going to sit with preferred shares. And in doing so, they have a fair market value associated with them. Well, guess what? John holds them until death or whatever. He is going to have a tax liability by holding those preferred shares at a particular value, correct? That's what we're worried about. We haven't gotten rid of John's tax. We haven't done it. In this restructuring, we have not done anything. But we seem like superheroes as accountants, don't we? Look, John, look what we did for you. We use this elaborate language. But at the end of the day, all we're doing is we can estimate that future tax liability or potential tax liability. And then my insurance brain comes in and says, well, then let's insure it, right? So I always say there is an opportunity to have that collaborative approach whenever an estate freeze is done. Now, don't get me wrong. We're working with an accountant right now where we're doing these freezes, etc. I put this together in one slide. It's paperwork. It's a binder. It's valuations. It is a lot of work to get everything done. But here's my next slide. Rich Canadians are getting out of paying tax with estate freezes, and the CRA endorses it. Okay, now that's spooky, right? That's Halloweeny. Wow, I just said to you, this is a very positive thing for John. This is, we're talking about succession planning. And there's this article from 2019 that says what he is doing is offensive. So the author says the CRA's position is baffling. It views an estate freeze as a garden variety tax planning, and other countries aren't as neat. So I have my tax brain on. Boy, I do not agree. So let's dig into this article a little bit, because I want you to kind of get the perspective of what they're saying deep inside of there, because that's an eye-catching headliner, right? So it says John owns preferred shares of Canco. So remember, in our estate freeze, John now has preferred shares that he has frozen in value. They're now worth $10 million. And his children will now own common shares. So that's our other side of that transaction of an estate freeze. So in doing so, as the years pass, John redeems his $10 million of preferred shares. And we'll talk about that, what that means, etc. And he's going to pay personal tax as a result. When he passes away, Canco's only remaining shares are the common shares that his children acquired during the freeze. So do we have the story so far? Dad, 10 million, kids have now shares. He's now essentially redeemed these shares that he has to essentially reduce to zero. Is this sound offensive? I'm still shaking my head. No. What does the author then say? The author that says the company has been transferred to John's children without any capital gains tax on death, and more than $20 million of tax has been avoided. And the author concludes to say a good starting point would be to legislate estate freezes out of existence. Oh. Wow. Do you think this was written by a tax professional? I would. So Paul in the back, if you, Paul, I value all of your comments in life, so thank you very much. Oh, goodness. So look at what someone has written. You know, again, I turn back to, is this what John intended, etc. If I go into, what does the average Canadian think of an estate freeze? Oh, well, I can turn to, Google and go, okay, here's a bunch of articles about state freezes. There's lots of tax articles by many law firms, etc. There's even a CCH book on implementing estate freezes. It's a common practice. And if we think of the language that we used, it's not offensive. It's really just saying, I am just restructuring in a manner to bring succession, etc. So given that, the language that we normally use, and I sort of gave that before, it is a wealth preservation tool, correct? And I say a tool because all we've done is restructured and we've locked in or frozen the value for our client like John. It is a means of tax planning. It's not aggressive. It's quite, I'll say, simple in its elegance, but there's lots of work to it. And it's a means of succession planning. I can allow and have the ability to bring in the next generation. Question for the audience. Where did I get this language from? I wish. So someone said CRA. This is from ChatGTP.
Oh.
So I'll put the nod out to Sarah if you've heard her discussion earlier before me. Look at what AI is generating about talking about estate freezes. So here's my thoughts. We'll kind of go into this, here's the layer, here's what's been talked about from a both technical side and what happens from an article standpoint. But let's talk about structure, because a lot of people say, well, okay, you kind of gave us some, idea of what it is. What is it actually, how can we do it? So I'm giving you 3 different ways that an estate freeze can be done. I can do something like freezing the assets. The first one is if I have assets outside of my incorporated business, I can essentially transfer them to my corporation and take back shares that are frozen. That's one way. A lot of people do that. Think of that. Think of anybody, I'll say it's really typical from a farming standpoint, where we transfer land and do that. That's a really easy way. Same thing can happen from a property standpoint. The other 2, this is the ones we're going to talk about today. One being an external freeze. This involves a holding company. And I've got pictures, don't you worry. And I have the other one, an internal freeze. So in doing so, one involves a holding company, the other one doesn't. So let's look at an example here. I've got Mr. and Mr. B, A and B. They both have a company, $5 million shares each. They both have OPCO in there. And Mr. X says, or Mr. A says, well, I want to freeze my shares. I want to get a holding company set up so that I can have other members of my family be part of that holding company. And you can do that. And it doesn't interfere with Mr. B, which is the very nice thing about doing an estate freeze with other people that you're not related to, etc. So given that, here's the picture. So when I talk about it being an external freeze, like that number 2 one that we talked about, this is where people talk about that section 85. Does that sound familiar in terms of term? Yeah. So this is what it would look like. Here's Mr. A. He's still there on the top layer. He incorporates a holdco because he's now frozen that value of his shares of 5 million. Have we touched Mr. B? No, his structure is still the same. He still just has his common shares worth 5 million. So look what we did on top. We have now layered on Mr. A's successor, his spouses, children, etc. So that is the section 85. So when the accountant or whoever is talking about that, that's the language that they're using. So again, just the intermediate part of having a holdco. If I'm doing an 86, so my number 3 example, this is the internal freeze, okay? So this is almost the same thing. I've got $10 million of shares. That's my initial structure. And then what do? I freeze those shares for preferred shares, and we issue new common shares to either a family trust or the children directly. I put there a family trust. 2 comments about this when we're talking about that. Most lawyers will say, let's do a family trust. It provides protection. It provides all those things that a trust does in its essence. What's happening at the end of this year, if you have a trust, you must now report all the good people in your trust, your settlor, your trustees, all of your beneficiaries. Give me your social insurance numbers. This layer of confidentiality is being broken. So we've had the discussion of, do you keep the trust or not? But if you have the trust right now in existence as of January 1, you are now reporting all the people in that trust. Yeah, absolutely. Retroactive, that's the question. So CRA is going to put the pieces together. So be aware that everyone says, I want to trust. Ooh, there's this magic to it. But be aware that the veil is being broken. So I also say, who's in the party? Remember this, I've just given you structures. All we've done is restructured. I've basically put people together to be in the same party, like it or not, artificially, haven't I? I've said now, John, Sally, Mary, you get to all be in the trust. Go get along. The other part of it is, okay, all these kids, if you want to think about these new trust reporting rules, and these kids never knew that they were part of being this trust before, and now they know, that's a different element too, right? So given this, I will just put on the psychological hat now in many of these conversations that I think that are missed. Structurally, we can absolutely set up trusts, we can set up structures, etc., with an estate freeze, but we don't think about the human element of who's who in the zoo. Now, do spouses get along? Are they in, second marriages, etc.? Do we have siblings that get along? And do we have the lovely spouse that sits there as the daughter-in-law that says, oh, is there money there? So be cognizant of that. Get a trust deed. So the trust deed is the agreement that outlines who these beneficiaries are, who the players are, who's who in the zoo, because I will guarantee there's an opportunity for insurance here, correct? If we want to equalize or make sure we've got liquidity there, the trust, deed will sort of lend itself to who's who in the zoo. So let's talk about that. Do your kids get along, etc. I think, of course, there's benefits. I had to give you sort of I'll say pitfalls or considerations, but I'll give you sort of, I think, the positive side of everything if you want to make a list for your clients. It certainly freezes the testamentary tax liability for clients. I know right away that we have a $5 million tax bill or whatever the number is. I can ensure that. I'm deferring the tax to the ones I love so that future growth goes to them. But I can now layer on different things. I can now have, maybe I crystallize my capital gains exemption, or I can creditor proof, or I can incorporate that family trust. And then on the other side of it, of course, I'm going to say that there's a corporate insurance opportunity. Because those shares, remember, those fair market value shares that dad or mom owns have a tax bill associated with them. So if I'm a beneficiary, I want to make sure that there's liquidity to pay for the tax. But the other part of it in terms of these strategies that go together, and this is where the accountant will say this, is let's do a wasting freeze. You've heard of this before, right? So the idea of a wasting freeze kind of goes back to John's story. Remember how he said that he redeemed his shares over time and basically had none left? That's the essence of a wasting freeze. It sounds simple, but here's the thing. When we think about a wasting freeze, I'm going to just sort of say we go back to John's story a little bit, but maybe put the numbers at 5 million. So same picture, we have a taxpayer, excuse me, of $5 million, he preferred shares, and then his family or family trust have the other common shares. So here's our starting picture. The accountant says, well, let's do a wasting freeze whereby you will now redeem those $5 million of shares. So it sounds like a good thing because then the language turns to, well, John or whoever it is, you're going to get retirement income from those shares, right? You're going to get income from these shares over time. And in doing so, well, think about this. John or whoever it is has to receive, or the company has to declare dividends. So maybe it's 100,000, right? Sounds like a reasonable source of income, right? So we start off with $5 million of shares. We say, John, you now redeem those shares. And I put the technical information on there that says, in this piece of the Income Tax Act, it's going to be a deemed dividend to John or whoever your client is. It's not a capital gain. It's not preferred tax treatment. It is literally a dividend now in whoever's hands. So the anticipated result is, okay, we redeem the shares during his lifetime. This is a lifetime activity. And then, because I've reduced the value of the shares from, let's say, 5 million or 10 million to a lower amount, that inevitably reduces my capital gains tax, right? You see that connection? And then if all the shares are frozen and are redeemed prior to death, the capital gain at death is completely eliminated. John's story, right? That was what they said happened to John. He had 10 million and then he got and received dividends during his lifetime, and all those preferred shares he had came down to zero. That's $10 million of shares. So we'll talk about that. There's a little schedule that I think clients should be aware of. And I don't even think the accountants do this for clients. They just say, oh, just take out 10 million or $100,000 of income. But do a schedule like this and say, okay, we had 5 million, take 100,000, you redeem them, reduces the value of your shares. Now you have 4.9. Same exercise, back and forth. After 20 years, I'm still left with $3 million of shares. Wow. So I guess I'm always puzzled by how, we don't talk about what's the end number. We don't talk about how old John is. We don't talk about all these other things when we talk about a wasting freeze. But essentially, it takes a long time, or John has to take a lot more income to waste those shares down. I like this graph. I've been using this form or fashion for many years now. Is John, can you tell me when you're going to pass away, please? So again, I gave the example of $5 million of shares, but what if John, has those 10 million? So it lends itself to, okay, client, if you're going to still sit there with $3 million of shares or whatever that amount is, can we talk about insurance? So the other part is you get to ask some good questions. What's the life expectancy of John? right? How old is he right now? Does he have this 20, 30-year window? Most people that do estate freezes, what age are they? They're older, right? Absolutely. These are not 30-year-olds doing this. Is there particular tax accounts that you want to recover? So RDTOH, remember that, where you've got passive income, and then part of that tax, that high rate of tax goes into that RDTOH account. It can be recovered as long as John pays himself a dividend. So that may be the reason why the contemplation of, having a wasting freeze. But it goes back to, does John or your client need the income? I guarantee John has other assets, right? He's doing well. All those things like that. Does he need this extra income? And maybe the spouse, maybe they need the income. So if John passes away with preferred shares, he can pass those on to his spouse. And I also think back of, is there funds available to provide for that income? We're saying you're going to take out $100,000. Is this a liquidity type of company? Is this an investment co, right? Is this stuff where that cash can be paid out? Good question, right? But we automatically think, well, let's just do a wasting freeze and no problem. There's a lot of, maybe I'll yeah, so the question is there a baseline where you would freeze shares, right? So is it $1 million? Is it whatever, right? So at the end of the day, you normally see, I will say, at least 2 million and up. It depends if they want to claim the capital gains exemption or if they have the ability to. So I normally don't see $1 million and below, but that's a good question. So I think that there's an opportunity with the wasting freeze. I really do. I've sort of give you that little, trip into there to say, hey, you may still be left with $3 million of shares, even after wasting those shares. So let's look at this example. Similar to what John has experienced, to say, if you have $10 million of preferred shares, let's assume it's some type of investment co kind of company. So I've got some potential liquidity, maybe, with those to pay some dividends. And I still have the other people on the other side holding common shares with little or no value. Let's do this. Let's think about this as providing options and discussions with the client and with the accountant on this topic. Let's tie in now estate freezes with wasting freezes and postmortem planning. Ooh, okay. So now the accountant's getting excited. They, like this is their world. This is their lingo, right? So at the end of the day, what are we really trying to do? If someone's doing postmortem planning, this is not planning you're doing now. This is saying, John, we will take care of business or eliminate or mitigate some of the tax when you pass away. So in order to implement postmortem planning, you got to ask the questions. Well, who are these shareholders still left in the corp? Is it the kids? Are they going to wind up the company, etc.? Is it a graduated rate estate? Because I can only do certain types of postmortem planning if it's a GRE. Do I still have other tax accounts like, and again, ERDTO, NERDTO, GRIP? That just really means RDTOH. Because remember the philosophy, I may have to recover, I want to recover some of that tax back. And then is there already existing corporate life insurance? Is there CDA that I need to recover? So again, there's lots more questions when it comes to an accountant considering postmortem planning. Because remember, postmortem planning is essentially just eliminating one of the taxes at death. So let's do this. Let's bring a dual solution that'll make insurance professionals happy, clients happy, accountants happy. That's a good world, right? So let's, I know, I'm an optimist. So let's think about the options with those $10 million of shares. If I think about, we're still going to do a wasting freeze, right? There's nothing wrong with that. He may still want some income from those $10 million of shares. It's still something the accountant's going to talk about. But we're going to complement that with life insurance. And I'm still going to suggest $5 million of life insurance, even though I've got $10 million of shares. So I haven't gone for the full amount. because I'm assuming he's going to waste as much as he can during his lifetime. So my expected result is, well, that individual gets some retirement income from those shares. There's liquidity there with the insurance. And again, I get to manage that longevity risk. When will John pass away? So let's look at the numbers. The numbers were hurt a little bit, but I want you to have it. There's a lot on there, but here's the story. If we say that in our option one, in terms of we're going to do a wasting freeze, because that's our typical accountant mindset. This is where we normally would go and suggest to the client. What would happen if we did a wasting freeze, but still layer on the insurance? My tax result is I'm hoping to redeem at least $5 million of those $10 million of shares. Does that make sense? We're going to try and at least get through half of them. But it's still over time during John's lifetime, he still has to pay tax on that. This is not a tax-free event. So we're just going to assume that the tax bill while John's alive is about $2.4 million. So I just applied a dividend tax rate. The corporation does get to recover that RDTOH back. Good. And now has potentially reduced the value of John's shares from 10 million to 5 million. Good starting story. I now have John pass away, so Mr. J. He does realize still a capital gain on those preferred shares. Remember that story. We have not gotten rid of those shares. We've not gotten rid of the tax. We've minimized it, but we now have at least reduced it. The insurance still sits in there for $5 million, and I can pay then a tax-free capital dividend to redeem those shares, right? So I'm going to say, thank you very much. These shares are really nothing. Here's the liquidity. The tax side gets a little bit, it gets not tricky, but there's some lovely things to it to say. When I do that, when I have someone have a capital gain at death, I then have and create a capital loss in the estate. And I have the ability to carry that back to my terminal tax return. That's postmortem planning. That's all it is. And in doing so, I can't carry the full amount of that capital loss of 5 million. I can only carry back essentially, I'm maxed out at 2.5 because there's those rules called stop loss rules that hinder the amount that I can carry back. So essentially, if I have still 2.5 that I still have to pay tax on, the tax bill is about $668,000. But I have insurance. I've paid a very nice hefty capital dividend out to the client, but there's still some tax there. It's still a good result. And we still did the wasting freeze. So don't be shy to talk about insurance, even if the wasting freeze is talked about. So the tax result, and you can, to discuss this with the accountant or with the client to say, well, those shares, you're going to be still left with that $668,000. The amount that you're going to redeem during your lifetime, there's that 2.4. Remember that number from before? By him redeeming and the tax at death, the tax bill or total tax bill is 3.1 million. Still a big number. That's not to be at all dismissed. So if I think about this in terms of combining wasting freeze, insurance, and postmortem planning, I go back to that win-win story, that collaborative approach. Here's the twist on this. I told you most clients that have $10 million of preferred shares or $5 million of preferred shares, they don't need the income. They don't. So what if we do not waste the shares? Do we get a better tax result? Do we get the same? That's what we need to kind of explore. But I still want insurance in there. I still want the $5 million of insurance. It's the backup plan because it still says, well, maybe you will still do some wasting or whatever it is. It allows at least a buffer of liquidity if John passes away. So in this scenario too, no wasting freeze. John still at death has $10 million of shares. There's still a tax bill there. And now it's just a matter of we have the insurance as a liquidity instrument. So Mr. J, John passes away. the capital gain is bigger, right? So we had $10 million of shares. I now have basically 10 million capital gain. If I have the insurance for 5 million, I can still pay that out as a capital dividend, right? There's my $5 million of insurance as liquidity. But I still have to pay tax on the remainder, right? 10 minus the 5 gives me that remainder of 5. I pay the tax on that remaining 5. It's funny enough, the tax turns out to be almost the same, 2.4 again. My step 3, my stop loss rules do not apply. Oh gosh, why, Jos? Because think of that terminology we've heard, the 50% solution. I haven't paid out that full amount of capital dividend of 10 million. I've only said 5. So when I do my calculation, my stop loss rules don't apply in that realm. I can still carry back the $10 million of capital loss to that terminal. Good result. So what is the result? I compare option 1 and option 2. Remember the 3.1? That was wasting freeze plus insurance plus postmortem. No wasting freeze, insurance postmortem, my tax is less. That's all it is. I think we just don't do enough option or comparison planning whenever we have discussions, you know, in a collaborative group. It's just say, what if we explored this? It still gives John or wherever it is flexibility if he chooses to waste or not, but the insurance is the backup plan. Think about Aaron Rodgers. Like, okay, again, football fans are not, but he needed a backup quarterback. He's not great, but he's there, but insurance is great. So imagine that in terms of that opportunity for clients. So that I think has to be done. Option 1, option 2. Here's the thing in terms of as that solution. An estate freeze just fixes the capital gains tax. It's just a restructuring. It doesn't make the tax go away. In John's case, he paid tax. And it doesn't provide the means or liquidity at the end of the day. Life insurance and should be an integral part of the planning process. And it manufactures tax-free capital dividends. That's the key. Returning from taxable dividends to tax-free ones. And again, just layering on another tool for our clients and showing them option 1 or option 2. So the other part that I wanted to talk about then is we have John's picture, right? Here was this scathing article that he didn't pay tax. Okay, well, I just showed you, he probably did pay some tax along the way. And then ultimately for any CPA, we're just trying to mitigate the tax liability, right? For the estate freeze, that was what we were trying to do. We froze the value of the shares to not have the value keep going up in John's name. So when I think of mitigating tax, we kind of have these different tools, don't we? Estate freeze, that stopped or froze the tax, didn't make it go away. Postmortem planning, well, it reduced the tax. So that's a good thing, but it didn't get rid of it. Capital gains exemption, John may or may not be able to claim the capital gains exemption. So I'm kind of really tired of people doing presentations about, well, clients, you're going to be able to claim this, you'll be able to save all this tax. It's not a gimme. So be aware of that. But the last one I want to talk about is the spousal rollover. Well, we all assume from a tax perspective that we can roll things over to our spouse on a tax deferred basis, right? That we're not going to trigger any tax. So it sounds good from a tax perspective, but I always say you're passing the tax on to the ones you love. And it's just a tax deferral. But I find that now we've got, you know, different relationships, second marriages, third marriages, whatever it may be. And is that really what you wanted? Does the spouse have even the capacity to take on shares? All those things like that. So I will say it's not a gimme, just like the capital gains exemption. We don't know what's going to happen to the client's personal situation in 10, 20, 30 years. But what I thought was very interesting, though, if you did just ignore that family law and all this psychological stuff in terms of marriage, et cetera, and spouses, how does the tax work if I'm going to roll these shares over to my spouse? And how then can that be a really tax efficient way than just have insurance, etc.? So in my example here, let's go to Mr. X and Mr. Y. Their company is worth 2.5 each, and we have spouse X on the other side of the coin. What does normally a shareholders agreement say? Mr. X, you get my shares and vice versa. Makes sense? For various reasons, we may not want the spouse in that situation. I appreciate that. But the thing is, if I actually do roll those shares from Mr. X to Mrs. X when he passes away, I do not have a capital gain for tax purposes. Agreed? Yeah. And so there's no deemed disposition. So this does really sound good. But here's the thing. When we do this, I now want to repurchase the shares from her, don't I? Like, it's one thing to say, okay, we got some tax preferred treatment, but is that really what Mr. X or Mr. Y wants? Probably not. He probably doesn't need or want her in the picture for various reasons. But we go back to that shareholders agreement. And I'm not a lawyer, but think about this, what that shareholders agreement says. It probably says that there's a mandatory repurchase of those shares by Mr. X and Mr. Y, right? If I die, then we're not going to talk about the spouse or anything like that. We just want this transaction to be between ourselves. So what this means is that the shares transferred from Mr. X to Mrs. Y must vest indefeasibly. We heard this term? So in order for this transaction to happen in terms of me rolling shares over to Mrs. X and then potentially having Mr. Y essentially redeem those shares by the corporation, I can have this rollover happen. And when you think about that, that's not what shareholders agreements say. It goes back to those shares must be purchased by the other person. There's no talk or speak of a rollover happening. So I encourage the conversation, much like we did with the wasting freeze, etc., to say, well, if the terms of the shareholders agreement provide it compulsory, the executor of Mr. X's estate to sell the other property to Mr. Y, because that's normally what would happen, these would not be considered vesting indefeasibly in the beneficiary. So it's a key thing that's missing, or that spalls a rollover to happen. So I encourage that conversation, like I said, that maybe these shareholder agreements need to be a little bit reworded or thought about to say, if I want the terms of the shareholder agreement to look like I want the shares to roll to Mrs. X and then have the redemption be done by the company, this will actually allow for those shares to vest indefeasibly. And I've met the requirements of the Income Tax Act for that to happen. So this is a good thing. So in doing so, and what I'm getting to is, here's my tax result. If the shares roll to Mrs. X, there's no capital gains tax. OpCo is going to repurchase the shares from her because we don't need her or want her in the business and she wants liquidity, correct? But I want to add insurance. So what we're going to do is we're going to get $2.5 million of insurance to basically say, yes, we're going to pay you out, Mrs. X, but we're going to pay that out via insurance. We're going to have that on a tax-free basis. And when you do that, the stop loss rules do not apply again. This is a little magical result. No capital gains tax, and you now have the relationship still intact. Mr. Y still takes over. Mrs. X has liquidity with insurance because we've now repurchased the shares from him. Again, is there a spouse involved? Like this, when I think about the tax side of it, I gave you some numbers here. My first column is the typical loss carryback that we just talked about, even with the wasting freeze. We said, if I have $2.5 million of shares, I will have a capital gains tax effect, but I can carry back the capital loss. So I still have some tax to be paid. in my, what's called in, in the insurance world, roll and redeem. It's basically a spousal rollover to redeem the shares back. I have no capital gains tax in. So it's very effective. No capital gains tax, no deemed disposition. I again have a really effective result. The last slide, and just to hurt you before again you leave me today, it is really just to say it proves my point from a number standpoint. I go back to, if I have these $2.5 million of shares and I have life insurance, my favorite row there, 2.5, I still have that loss carryback issue and the stop loss rule issue. I can only have 1.25 as the amount I can carry back as a capital loss. Effectively, the tax is about 24.5%. It's okay result, it's better. That's because we had insurance and a lot of other things. The roll and redeem effectively gives me a zero tax result. So in my options that I want to provide for clients is there a spouse involved? Do we need to think about, doing a wasting freeze or not? If we're going to roll to the spouse, is that something she wants or he wants in that? But in the end, insurance has been a common denominator in all my examples, correct? It really has. It's the liquidity instrument to say, whatever restructuring you're going to do, whatever type of, wasting you're going to do, whatever type of, we're going to move shares around, the liquidity instrument still needs to be there. The cash to give options at the end of the day have to be there. So again, even though he had or she had $10 million of shares, we just showed what 5 million could look like. We just showed what option 1 would look like versus option 2 look like. There was a differential in tax. And at the end of the day, that spousal rollover, if you are considering it or having those conversations, it's a lot more intricate because you need the language inside the shareholder agreement. You need the conversation and that good relationship between spouses or the mental capacity to take that on as a spouse. And again, the understanding by both parties to say, Mr. X, Mr. Y, yes, there's insurance here. We just need to make sure that you understand, yes, Mrs. X will not be in the picture, and that's okay. Right. So I think when we think about estate freezes, the opportunities are there. The opportunities to talk about insurance are there. It brings the liquidity. And so that's why I thought it's a good marriage of conversation. So I will close out my conversation about estate freezes, tax, and all the kind of things that you need to worry about. But again, common denominator, insurance. Well, thanks very much.
Thank you, Yas.
Yeah.
Thanks very much, Yas. Questions? I'm going to actually start. Yeah, got your hand there. I'm going to ask that there is actually one in the chat. So I'll start with that today. Hold on, Steve, Luke. Question from Melissa. Taxes are obviously very important as a cost, but why haven't we discussed the cost of the insurance premiums? It would be an added expense to this strategy, correct?
Yeah, so here we go. The question was, hey, you haven't factored in the insurance premiums, right? That's a cost. And isn't that what the accountant says? It's going to cost you X amount to put this insurance in place. But I will say at the end of the day, it's there from the get-go. This is almost a cost of doing business. This is a cost of doing an estate plan, et cetera, much like the restructuring that the accountant has to do, the lawyer has to do. That liquidity is there from day one. It's just part of that instrument that we need. So again, is there if you think about the reduction of the value, I'll make it to a different twist on this. If I reduce the value because I've paid premiums into it, it's actually reduced the value of my corporation, right? So it's almost a moot point.
Thank you, Yas.
Yeah.
And Rob has a question. Is there a mic that you can give to?
Just a question on the buy-sell agreements. Why don't you see the spousal rollover? Just wanted your thoughts on why you don't see spousal rollover being more commonly used, because I don't think we see it very often.
No.
And it seems like it makes sense.
Yeah, so his question was, well, why don't we see now more spousal rollovers in that document, the shareholders agreement? It's a good point. It goes back to, lawyers may just pull a template out of their toolkit, and we've seen that. So we just kind of go with what we know. The other part is, remember how I said, is that spouse, does she have the mental or he have the mental capacity, all those attributes we need in that spousal relationship? Are they in good terms, etc.? Because if they're not, then we just kind of go to our default. Is that fair? And that's why, again, we don't always see the spousal rollover happening. Good question.
One more question. Yeah.
Yeah. Sure. Yeah, so his question is, okay, I mentioned 50% solution, and the other one is 100% solution, where I just basically take that whole capital loss back. You know, it's really just a matter of each client's going to be different. And so remember on that one table, he's right. There's a remaining CDA. Do you want to keep it? Who's going to get it? Like it's certainly not to be dismissed. And I think it's a really important thing that clients understand. Do you want this benefit be for you or to the other people that you've left behind? And so it's not a right or wrong answer, right? Yeah. But I think there's one more question about it.
There's
I
one
feel
more
bad if we
question,
don't answer it.
Mehul, and then we'll have to, yeah, shift on to the next question.
Is that on? Okay, there we go. Hi, yes. Question about grip balance. So, my assumption here is that when the individual passes away or when that freeze is done, we're looking at the grip balance. Is that essentially frozen with those shares? Like, I guess my question is, if the company in and of itself generates more of a grip balance going forward, can that individual with the preferred shares be able to utilize that? Or is it what that grip balance was on the day of the freeze?
Yeah, so his question is, if I have grip balance in terms of when I freeze those shares, can I use that balance when I froze my shares? So yes, exactly. So we would determine, oh, well, it's $1 million, etc. So that's why you would look to say, you probably would recover it or pay some tax, etc. But I still encourage you to do option 2. What if we just did not get that redemption back or recover that tax back? See what our better result, or if it's the same, because you at least have to know. So another good question. Yeah. Yeah, so he's asking, yeah, is it capped? It's not capped, like anytime it's a tax account, it'll change over time, right? Yeah, so that's an option to kind of look at, like, what is that value? Yeah.
Well, thank you so much, everyone. And let's give Jos a big hand here. Thank
Thanks very
you.
much.
So if you do have more questions or have specific, scenarios that you want to discuss with Jos, you'll be around.
Oh, for sure. Yeah.
Okay. And Jos, there is a question on the chat that we didn't get time to, but I might just share with you and see if you can answer it directly in the chat a little bit later.
Good.
So yeah, if you have questions for the speakers, you can continue to put them. We'll monitor it and then try and answer it. So we have a bit of a break for 8 minutes and then before our next session. So we have John Natali from Manulife Financial on the other side. He's going to be talking about segregated funds for estate planning. On this side, we have Raman Johal going to be talking about planning and pitfalls of joint tenancy. So grab a coffee, a quick break, and we'll see you here in a couple of minutes. Thank you so much.